All right, welcome to this video. We're going to be talking as a sort of part two to our earlier DOM basics. This video will be about correlations and important points regarding that. I think it's prudent as well that you follow, like, subscribe, and turn on notifications for further information we put out. All right, so I want to compare to start thick to thin. And for the duration of this video, we'll be using the treasury rates products. This will be our 10-year, our 30-year, and our ultra 30-year. From right to left, thick to thin, we'll have the fact that on the 10-year, we have usually 4 digits of size resting as limit orders. Come into our 10-year, we have about, on average, 3 digits. And finally, in our ultra 30 years, we have it as usually 2 digits, but there seems to be more business going on today. So when we have certain products that, like, this will have to be in theory, because with the ES, they have it set to the ES, they have it set as $12.50. And then the NQ, because it's more volatile, not necessarily just because it's thinner, but because it's more volatile, they'll have it set to about $5 a tick. And that's different because when you compare it towards the ultra 30 years, which is a bit thinner, but is not as volatile as NQ, this one actually comes out to about $31.25. And so that's just how it tends to get set. Things just get set based on volatility, and that's why in most cases things also get adjusted regarding the minimum bounds required to trade these products. And it's important to know for scalpers, because if you're going to be trading a product that, say, has low tick value and doesn't also move far, it's not worth it. There's no gain to you to be trading that product. You'd be racking just up commissions for nothing. And so it's nice to have products that are higher in tick value and can move decently, or are high in tick value like the treasuries, and you can learn to predict and have probabilities in your favor where you can size up. And so likewise with the fact that this is an ultra and this is the regular 30, this one as well comes out to $31.25 per tick. And being able to just stack up, let's say 10 contracts of your own, you're now making $300.12 per movement in your favor at the same floor. So you could lose that amount if it doesn't go in your favor, but that's different for each thing. Now, the main thing with correlations is you'd like to have things that are a positive correlation as well as negative correlations. So for this video, I just have set up things that are usually positive correlated, as they are part of the same curve. But for example, the ES in an instance would be negatively correlated to the treasuries and vice versa. So on ES, you'd want to have, for positive correlations, the NQ and the YM. Whereas if you want positive correlations on the treasuries, you just want the rest of the curve. Now, not at all times will there be such a strong correlation in the same directions with positives. Sometimes there will be divergences, and the same goes for negative correlations. Like today, I know the ES is heading about down in a downward trend. Likewise with treasuries, that just tends to be something more fundamental. And it's important to sometimes know what kind of fundamentals are going about, but it takes about 10 minutes to realize how the correlations are behaving with each other. And the main reason why it's important to know about the relationship between correlations is, if you were to have trades going off on ES, you'd like to say that the NQ usually is going in your favor, and that usually the curve, or let's just focus on maybe ZN, is trending downward. But if you are looking for trades with this kind of correlation, and if on the most of the day you see that the ZN have been trending downward as well, but then out of nowhere it begins to start trending upwards, this should give you pause. You should be considering that maybe things are starting to shift and that you'd want to readjust your views in that moment to how the correlations are acting together. It becomes important to note that, well, the fact that it gives you a chance to compare what is considered fair value. And when you consider it in that sense, if this was like a car situation where one company is selling a product at cheaper prices, why would these companies keep prices at a higher amount? They'll also tend to follow in. And so it becomes a sort of leader and laggard situation. And it's your job as scalpers to figure out within each of those moments, who is it that is causing these leader lagger moments? What in this moment is going to give you the edge? If you focus on just one market and you're trading the leading well enough, if you can read it well enough, fine. But there's more edge in the fact that if this became the laggard market and you have the leader and you can read your leader well, you could size up more efficiently on the laggard as it tries to catch up. This is important information. And when it comes to watching for a trend development, you can use the fact that if one is starting to tick strongly in one favor and you have a pause, and you know for the rest of the earlier day that they had such a strong correlation, you have a chance. Catch it on early. You're going to get that trend move following in as long as your correlations stay the way they have been. And this works for any markets, as most markets will have a correlated product. ES has the NQ and YM. The curve has itself. Sometimes they can also just clue you in with inverse correlations. Well, I hope this video gave you a quick sense of the importance of having correlations. I think it's prudent as well that you like, subscribe, turn on your bell, and just keep track of us, guys. We like to make sure we get these views in, and we'll do our best to supply more of these sorts of videos. We're always up to suggestions as well. Make sure to leave them in the comments, and we'll see you for our next videos. Thank you.